Okay, recording is on. You guys get my screen. I hope the audio quality is good and the voice as well. If there is anything annoying you, like bad connection, lagging or something like that, please let me know, because I have several internet connections I can choose from, because sometimes one of them is not working properly. All good and works. That's good to hear. Okay, guys, thanks for being with me. Thanks for joining. Today I want to talk a little bit about risk, because I mean it's a boring topic, and you probably know by now by reading our course and people talking about this all the time. But talking to 10 people, 7 or 8 probably still don't get the whole concept of risk management. So I really want to dive into this today, and of course in the end you have time to ask questions. This doesn't need to be about risk, but I want to start with risk and see what maybe I can cover some holes in some people's knowledge with that. Okay, first of all, why do we manage risk? It's pretty simple, to be honest, because we're trading in a probabilistic environment, so we can never be certain of an outcome. So, and without certainty, we of course need to manage our risk. So the basic concept of risk management is that we're able to lose 10 times, 20 times, 50 times in a row without being completely wrecked. This is very important, especially in the beginning stages, that we keep our risk very small and very tight, because it's very likely that we're going to lose a lot of times, sometimes even 10 times in a row, 20 times in a row. I mean, that's not very common, but statistically it can happen. So we want to make sure that we really manage our risk properly. How do we do that? Usually the normal approach is to risk 1 or 2% of your account. If you're starting small, or if you're starting new, I would recommend to start even smaller, because risking 1 or 2% of your full portfolio, let's imagine you have like a 50K net worth and you're risking 1 or 2% in your early stages of trading, the amount of money you risk is probably a little bit too much. I mean, we're talking about $500 per trade, which is just a little bit too much. So let's say you start out with trading and you collect your first experiences. I would recommend to only take 1/10 of that, which is 5K, or even less than that. Some people even recommend paper trading, and while it can be very helpful to eliminate all the emotions and just learn the edge and just learn the technical stuff of the side, I think it's important to trade with real money as well, because you really need to experience those emotions, to get to know yourself, to really what it means to trade. And so I would recommend to go with a small amount of money, which is not hurting you. This can be $10, $100, $1,000, $5,000, but I would definitely not go above this. I would rather recommend with $1,000, because this is the amount of money you risk 10% at $10 per trade, maybe up to $20, 1 or 2%, which is something that makes you feel something. And if you, for example, hit a 5R with $20, it's already $100. And so you really get to know the feeling of making money, losing money, and experiencing this yourself. So take a small amount and risk 1 to 2% on that, and learn trading with that is what I would recommend. This is one side of trading, like the 1 or 2%. Let me write this down. 1 or 2% of an amount of money which doesn't hurt you at all. And play this consistently. The thing is, another reason why we don't risk so much is because we play risk to reward. I drew this trade window here, And as you can see, this would be a 5R trade. This means my 1 to 2%, if it hits the best case target, would be 5 to 10%, which is already a good gain. You have to consider the math behind all of that, because achieving 10% a month is like already around elite level. Of course, there's always room to be better, but if you consider that the best traders in the world achieve around 100%, some even only 30 to 60, some above 100, of course. But I'm talking about consistent profits here, not about 1 year 1,000% and the next year like minus 80%. No, I'm talking about consistently achieving 50%. A 50% gain is something really only pro traders achieve. And with this risk management and understanding risk to reward, it's definitely achievable if you're not greedy. And so we only take trades above 3R for exactly that reason, because this means we can be wrong 66% of the time, and we're still ending up break even. So from 3 trades, you could lose 2 and win 1, and you're still break even. And this is, or you're still up actually. And this is something you really need to hammer into your head, because this is the boring stuff. This is what nobody wants to do. This is the stuff nobody wants to hear, to be honest, because it's just basic math and boring discipline and executing again and again and again. And you will take a lot of trades which might not even reach your best case target, but you will TP around here, you take out 1 hour, 2 hour, 3 hour, and this will accumulate into a big portfolio if you are consistent, if you're disciplined, if you don't chase those big numbers, those big percentage gains, chasing the dream more or less. If you're able to stick to a mathematical statistical system, you are sorted basically, because this is a big part of the edge itself. And if you don't stick to that, and if you don't know the math behind it, it's going to be very hard, because the game is rigged and you're playing against the house. For example, take a casino. A casino is built for people to lose. Otherwise, it wouldn't exist. Why would somebody build a casino for millions of dollars just to give people free money? This doesn't make sense. And the same principle applies to the market, because this market is created to drain money from one side to the other side. And this one side is the house, the market makers, the whales, whoever you want to call them, whatever you want to call them. And they are the house, and you need to beat their system, because in trading, you can define your own statistics. In a casino, you cannot, because if you play roulette, for example, it's just a game of luck. So in roulette, there's really no strategy other than betting on the highest likelihood. And the highest likelihood you can bet on roulette is black or red. And it's not even 50-50, because usually they have the roulette with the green 0, which shifts the odds against you. And so statistically, you have something like a 64% win rate on a maximum payout of 1 to 2. I think it's like that. So you can double your money if you're right, and you lose it if you're wrong. But your win rate is only 64%. So statistically, if you play long enough, the house will always win. Of course, it's not that the house, it's not like if you play once that you always lose. No, but statistically, if you play long enough, the house always wins. And this is how casinos are structured. This is how like these automates are structured, roulette is structured. So every game that is based on luck is structured like this. In trading, just like in poker, for example, you define your own probabilities. You define your own statistics. And you really need to use this edge, because if you don't, it will be used against you. Because the whole market is designed to trigger your emotions, to mislead you and misguide you into the wrong decisions. And if you let it, the statistics are against you. But with risk management and proper sizing and an understanding what risk to reward really means, it's possible to beat the house over time. This doesn't mean you win every trade, but over time, you will make money if you just keep on playing the statistical edge. The good thing is, you don't need to start from scratch, because we all learned from teachers, from Money Tower, from other teachers, how to trade, and we have a proven statistical proven system that just works if you just apply it correctly. And this is what you should do. This is what you should do all the time. Just stick to the statistical system that's behind all of those edges. It doesn't matter which edge you're playing. The Money Tower edge is incredibly powerful, but you need to stick to those statistics. Even though it's boring, even though it will take a lot more time than betting the farm on a single trade and being lucky, this is just not, this has nothing to do with trading. If you do it like that, it's gambling. So we want to stick to the statistics. For every trade, at least 3R, and up to whatever the trade gives you. But just a rule of thumb, for example, if you're long this here, your target should not be 200K just because you need more R. It should always be a range trade, first of all. And if it breaks out, usually it gets swept or something. People think, oh, it's going to break out. But until a breakout is confirmed, it's a range, and you should trade the range. And if it goes higher, that's great. Trail it. Trail the rest. But I would always TP within the range, the 0.5 supply, locking in gains, and being aware of what you're doing here. Because people usually, if they're in a good trade, they think like, oh, this is my best trade ever. This trade is going to be it. This trade is going to pay me so much and this and that. But remember, it's not about this one single trade who's going to make you rich. It's the amount of statistical proven trades that are going to make you rich. I can show you a statistic actually. Let me open this up because it's better to visualize. Where is it? Here we go. Need to change the window. Give me a second. How about that? Can you see this? Yeah, looks good. Okay. This is an equity curve simulator. We try something here. Let's imagine we have a start equity of 1,000 euro, yeah? A win probability of 50%. And we play a 3-to-1 edge. Or we click on that. No, we play a 3-to-1 edge. We execute 100 trades. Number of lines means number of traders, so 20 different traders because the statistics are not always the same. And we risk 1% per trade. And our statistics will look like something like this. We start with 1K, and an average we reach for almost 3K. We have some outliers, of course. We have some underperformers, of course. But statistically speaking, this curve is going to be up only from here. Why? Because with a 50% win rate and a 3-to-1, it means with every trade, you win at least 3 times as much as with your losing trade. You cannot lose. So it's statistically not possible that you lose from here. So if we shift this and say it's only a 2-to-1, the curve looks different, but it's still, you get twice as much. We have a little drawdown here, but overall the curve is still up. And a 2-to-1 trade is very likely. If you trade your setups, if you play the Money Tower edge, for example, and you aim for 3 to 5, 6, 7R, it's very likely that your first TP is going to be a 2-to-1 and sometimes even higher if you know what you're doing. But in the beginning stages, you should probably lock in some gains, remove the risk, because if you can't read market structure properly, it's better to trade the reactions, take out some money, remove the risk, be happy with what you have. If the trade keeps on running, great. If not, you're already profitable, which is good for your mental game, good for your wallet, good for your statistics, and you also remove the risk already. You see, if we play the same edge with a 50% win rate on a 5-to-1R, the curve gets already a bit steeper. We're already at 6K here after 100 trades. We have some outliers at 10K. We have some at 4K. But overall, the curve gets, of course, steeper. Let's see what a if you're able to increase your win rate to 70%, you see it's also nice up only curve, some outliers here. And the thing about this curve is that for most of us, and especially in the beginning, it will probably not look like this, but more like up and down and up and down and up and down. Why? Because the mental game is ruining so many trades that people are usually stuck in some kind of, what is the word, boom and bust cycle, and they don't stick to the statistical edge, because as soon as they face a loss streak, and you see all those statistics here, and we were talking about a 70% win rate, right? 70%, which is very high, believe me. And you still face in the course of 100 trades, it's very likely that you still face a 6 consecutive loser loss streak. And if you just keep on playing the edge, no problem. But usually what happens is that people fuck it up on the loss streak. Or look at this, 16 consecutive winners. This probably feels amazing, the amount of euphoria you get from that. And then you will probably size up, or you will think you're unbeatable, all this stuff. It's not the statistics fault. It's not the fault of your edge. Usually it's the fault of our people, of ourselves, us traders, who ruin the statistical edge of things, because first of all, the market is designed in that way. And second of all, because in the beginning, we lack self-awareness. We don't know how to deal with those emotions. And of course, we project a lot of hopes and dreams onto the market, which is in the end ruining our statistics here. And you see, 70% win rate and 6 consecutive losers is nothing uncommon. So if you, for example, risk 20% per trade and you face something like this, your account is gone. And we're talking about a 70% win rate. Let's reduce this to 50 again. And I mean 50, for most beginners, 50 is even high. 7 consecutive losers. You surely don't want to risk 10% per trade here, because that means 70% of your account is gone by then. And let's imagine for a beginner, the statistic look more like this. And even if the graph is going higher in average, we have a lot of people facing drawdowns here of those traders. We have some people overperforming, of course. But overall, if you stick to that, it's still a profitable edge. But I mean, this is surely not fun. So this doesn't look like fun. And I mean, a 10% risk per trade means your account is blown, and even a little more. So keep those statistics in mind. It's really important. Keep those in mind and think about what's possible if you play it right. 60% win rate, 5-1. You see a 1K account can be, after 100 trades, properly executed just like that. I mean, the reality is, of course, not math. It's not perfect. But overall, you can make so much money. It can become so exponential. I mean, look at this outlier here at 20K. So this is certainly possible with trading if you stick to your system, if you stick to the risk management stuff. And I can't tell you this often enough, because if you're still starting out with trading, look at this, starting out with trading and you're in the beginning stages, usually that's your most vulnerable stage, and usually that's when people ruin it. If you look at the statistics of how fast traders quit, usually within a year, I think it was 70% quit already or are broke, and after 2 or 3 years, it's already at 90% or something, because it's just tough. It's a performance environment, and you need to be on top of your emotions and everything. So you need to take this seriously, and only if you manage your risk properly, you can survive for long enough. Let me tweak those statistics. Let's imagine a 10K account, 50% winner, 3-1, but we have 1,000 trades here. So 1,000 trades, and I mean, this looks unreal, right? This looks really unreal, but this is the power of trading. This is the power of compounding. This is the power of exponential growth, because in the first 700 trade, almost nothing happens, and then it like explodes. I mean, I can also put the scale on log, which looks like pretty crappy, but you see from this 10K, we go up 100, 200. It goes up in a straight line, more or less. But if you don't put it on log, it looks like this. I mean, this is not realistic, of course, because you will face severe liquidity problems trading with those amounts of money. But still, this is definitely possible with trading. It's an exponential field without financial limit if you understand the math behind it, if you understand the statistics behind it. And even a small account. Look, I mean, we're talking about serious amounts of money, but it takes a lot of time, and exponential growth happens in the last stages. You will go flat forever, and your line will probably look like this, more or less, and then it will grow and grow and grow. And probably if once you reach 1 million and all that, you need to look for other businesses as well, because trading crypto alone, such amounts of money is probably a little bit crazy. But overall, you see exponential growth, no financial limit. It's definitely possible. The math is confirming this. And still, this is nothing fancy. A 15% win rate, 50% win rate, 3 to 1. And this is something you can achieve, to be honest. This is definitely achievable if you stick to the system. Okay, we're back to TradingView, right? Yeah, looks good. Okay, so how do we apply this? As you know by now, probably learned with the course, from Money Tower, from the internet, from everything. Oops, that's the wrong one. We are looking for breaker blocks, hidden order blocks, whatever you want to call it, and we want to manage our risk around. I would recommend to stay on higher time frame, even though there is a lot of times there's nothing to do. But playing on higher time frame is where the real money is. It's just like that, and everything in between is fun, and it's for you beginners nice to learn. You can increase your experience by tenfold if you trade low time frame trades, if you execute more trades, because higher time frame trades, of course, don't come around every day. But if they come around, you definitely want to be ready for them, because if you be able to catch something like this, and let's imagine you took it a little wide on an 8% stop loss, which is in the end, looking at the chart, not so wide. You see what's possible there? I mean, you probably take profits at the highs. You should definitely, because as mentioned, everything is first of all a range. So you entered here, you take profit at the highs, you trail your position. You probably, once the momentum shifts, you probably take another profit at those highs, or you take profits on the way up just because you can. Remember this, there is nothing perfect in trading. There is just the reality of being profitable or not. So it's not about the perfect entry or the perfect exit. I mean, okay, maybe the perfect should be pretty much, the entry should be pretty much perfect, but there is nothing about the perfect exit. So for example, if momentum shifts here, what it does, it was up only. We have the first big red candle here, a weekly close below. It's better visible on weekly, visible. You see the trend breaks and you TP the rest, or you put your trailing stop loss somewhere in this neighborhood. And once this breaks down, the rest gets stopped. But in the end, let's imagine you took a TP here. Let's imagine it's like 30%. So you already realized 1 point something R, 1.5, 1.8 R. Then at 11, 12 R, you take out 50%, which is not your full position anymore, which just adds probably around 4 to 5 R. So we're already at 6 R. So, and then you get stopped with the rest here. So we probably pulled 7, 8 R out of this trade, 6, 7, 8 R, depending on how big the profits were. And this can be your easy money plays if you know how to play them right. And remember this, we were talking about a 3 to 1 R here. And if you stick to higher time frame plays as your easy money plays, of course, as said, you can do a lot of things in between. But for size and for easy money plays, I would recommend to stay to high volume assets and to higher time frame levels. And then this can change quite significant. And I mean, let's imagine you pull a 7 to 1 R. as said, even small accounts can grow very fast if you just stick to the statistics. But as mentioned, usually what we do in the beginning stages, we don't let statistics play. We cut our winners early. We cut our losses too late. We think we are smarter than the market, all those things. And this makes sure the house always wins. But it doesn't need to be like this in trading. Define your risk rather small, and be happy with those gains. 1 to 2%. Let's imagine you risk 1% on this trade. We said 7 hours. So this trade alone added 7% to your account. You need to think like that. This is how a real trader thinks, because you don't think like, oh, if this trade hits a 20R, I can buy this and that car. No, you think in percent, and a 7% for one trade is a very good performance. Let's imagine you put on 3% here and you hit the 7R. That's 21% for your account. You need to consider that the major hedge funds of this world, they take thousands and thousands of dollars for their services. They're only able to perform a 10% average. My father is in some investment firm with his money. He lets invest them with his money, and he pays them thousands of dollars for their service of achieving an average 10% a year. Some years it's even lower than that. Some years it's even higher than that. But we're talking about average here. You want to have something consistent. You don't want to have something like in 1 year I have 1,000% and next year I pay it all back because it's a bear market. No, you want to have consistency. And you know and consistency only comes from knowledge and from experience. And as mentioned, if you're able to pull 20% with one trade and add this to your portfolio, I mean, this is already a good performance. And if you combine those with more plays, mid time frame plays, lower time frame plays, you add a percent here, another percent there, 30 to 50 to 60%, sometimes even 100% is not that hard to achieve. It's just about you understanding the statistics, being in control of yourself, and don't let greed take over. Just play the statistical edge. That's the lesson of today. So guys, bring me some questions to the topic. And it's actually quite simple. It's everything that's necessary is written here, and I showed you this just as example, what's possible if you just stick to those things. Of course, the reality is a lot messier. I know that. I know that from experience. And a 3-hour trade is already a good trade. And oftentimes our trades don't reach best case targets. But that's why we are happy with gaining 1%, 2%. Because if you take 10 trades on 1%, 2%, that's 10 to 20% already, you know? And if you trade the most higher time frame, the most optimal higher time from key levels, you usually always get a reaction out of there. And your job is just to take the profit and to remove the risk. How does risk come into play when you have spot? Good question. I have something written down so it's easier for me to don't talk shit, because it's quite complicated how my accounts are structured. Let me check where it is, but yeah, I don't find it, but I can tell you like this, I guess. So my approach with spot is that I only play spot on most higher time frame key levels. So perfect confluence, higher time frame levels on all majors, and I'm scaling in around those levels. So spot is for me not as precise as perp need to be, because for example on ETH, where's my mouse? For example on ETH, oh, it's full of garbage. Here as well. Okay. So on ETH, for example, I started scaling in here because there was this 2-month level, and I scaled down all throughout this range. My invalidation was here, and as you can see, we never ever closed below this low on the weekly. And for higher time frame spot plays, I usually wait for closes. So for me, it's not putting in a position and having a fixed stop here and getting stopped out here. For me, it's a soft stop. So I want to see closes below before I start consider selling. And I started buying here, and I bought all the way down here, and I ended up averaging between 1800 and 1700. And I don't even draw those trades, but it would look like something like this. And technically on a hard stop, I would have been stopped, but as mentioned, no closes below, everything is fine. And I target range highs. I took a TP yesterday, as I wrote in the update, which is overall also a very, very great trade by now. Or let's say it was like this, because here I did my TP here. And my spot risk is way bigger than my perp risk. So for example, how should I explain this? So I have my whole net worth, my whole portfolio, yes. And I'm trading mostly crypto, and I'm living off trading. So I have a lot of money in crypto, because as I said, I'm a full-time trader and I'm trading mainly crypto. I have some other accounts as well, and I'm scaling up my TradFi accounts by now and my investment accounts and all that. But overall, I have around 60% of my trading capital. So I'm not talking about my whole net worth, of my trading capital, which is like, yeah, something like 50% of my whole portfolio, for everything I have, is like for trading and investments. And it's more like 60%, more like 60%. And from those 60%, now it gets complicated. From those 60%, around 60% is in crypto, or 55, because I'm reallocating by now, right now. So 55 is in crypto. The rest is in TradFi accounts. This can be higher time frame investment plays. This can be shorter term trades, and whatever. So this is like almost by now it's almost, let's say 50-50, so it's easier. So 60% of my net worth in trading accounts, 50% in crypto, 50% in TradFi. In my crypto account, I have around, don't let me talk shit here. It should be, it should be 60, yeah, it's almost 60-70% is in spot plays, and 30% is on per play and for per plays. And those from those 30% and per plays, I have only 10% on the exchanges. So to make it even more complicated, I'm not trading full size on exchanges. So if I buy spot, I remove it from the exchanges anyway, and I use leverage as risk management tool. We can go deep into that after. That I don't need to have all the money on exchanges. So for example, I only have 1/10 of all I'm trading, of all my perp account on this exchange, on the exchanges, just because this is risk management. And so I basically risk from this money on my perp account, I risk 10% per trade, which is but only 1% of the money I want to trade with. If you understand what I mean. So I think I need to write it down, but you get it. Okay. Yeah, that's it. So leverage, risk management tool, 1% of the trading account, which just makes sense. And the rest is in purpose, which is also not on exchanges, which is for me a big risk management tool. We all know what crypto exchanges love doing, which is rugging, hacking, getting hacked, whatever. I really don't want to have this risk, because if I lose money on a trade, on a reasonable trade, this is okay for me to lose this money, but losing it on an exchange because I was too lazy to remove it, yeah, I would be very disappointed in myself and probably very angry. So I really want to avoid that. And yeah, so 60% in long-term plays, in spot plays, and right now I'm reallocating, as said, and the rest is for per plays. even though I'm not using all this margin on the exchange. How would you split a $10,000 portfolio? Assuming I want to split it into 50-50 for futures and spot positions, spot to play it on higher time frame only, and optimal and other ones for future. Could be scalping a low time frame or daily. Would you do it 5K, 5K, or 90 spot, 10 futures? Of course, talking from the perspective of a beginner. Yeah, so first of all, I wouldn't recommend to trade 50% on your perp plays. If you never traded before, or if you're just starting, from your 10K portfolio, I would recommend to use maximum 1K. I like to do the divided by 10, because this is really not hurting you, and your first year should not about making money. If you're good and if you're putting in the work, after a year you can see some consistency, and it can become very exponential if you put in a lot of time, the right time. And welcome back for everyone watching the recording. I had to restart it because it stopped. For everyone watching live, sorry. Yeah, as mentioned, 10% for futures is probably the way to go. I would also recommend, so I assume the 10K USD portfolio is amount of money you are able to lose without getting completely wrecked. So you can, of course, allocate the rest in spot. Right now, I would be a little careful, only scale into key levels, which might hit today, tomorrow, the next few days. So we're very close, which you can use to allocate into spot plays. And I would recommend from your 90% of spot money, do at least, from these 9%, do at least 70% into high volume coins. Don't buy a lot of garbage. Don't split your attention too far across too many different coins, too many different tickers. Just use high volume ones, because everybody who was just trading low volume shitters is probably back at break even by now. And even though ETH didn't even really sneeze by now, I mean, we dropped what, 10% from here. So this is really, yeah, 12%. So and most coins, so most low volume coins are completely wrecked by now. Yeah, which is something you don't experience on high volume ones. Even though, of course, it's still altcoins, you should still treat them as trades. But of course, at higher time frame key levels, your conviction can be a little bit higher, and you really want to allocate yourself at these levels, because those opportunities don't come around every now and then. So make sure you take those opportunities if you know what you're doing, and of course, they can be on more risk. And you can try to learn perp trading. And the beauty of perp trading is, for example, I only trade higher time frame ideas, to be honest. And my higher time frame idea from here is that we're going to reverse. And I caught some longs here, and I TP'd the longs. I didn't TP spot on Ether here. I was able to catch 5 longs on altcoins in this little area. I was able to ride this whole swing up here, TP'd on the way up, TP'd at the top, TP'd on the breakdown. So I TP'd almost all of my longs here. And this made me able to ride this whole move on my spot bag, and I added a lot of gains, and I was able to be more calm about my spot allocation, because I had so many longs which I could live off. And especially as a trader who's living off this money, I want to make sure to be consistently profitable. And while those spot trades sometimes take, for example, here ETH took me 114 days to major and to take out some money, I made consistent money with those perp plays. And also, of course, I can manage my risk a lot better. The position is a lot more precise. I can use less margin, because also if you buy a coin spot, there's also, of course, a risk that the coin is just rugging. I mean, on a high volume one, it's not so likely, but who knows? And so on a perp position, your risk is defined, and you need only a small amount of margin. This is the beauty of leverage, to be in this position. And if you know what you're doing, you can then remove the stop into break even, into profit, remove the margin completely, and you have a risk-free position, which is only based on profits. and cannot lose anymore. And you can use the same margin for another position, which is just an amazing risk management tool. This risk management strategy really broadens the view of effectiveness of the system and possibility of consistent process execution. By the way, I'm just reading out those questions loud because the people who are watching the recording cannot see the chat. So I reading them out loud so those people know what I'm talking about. Yes, and to be honest, all of that, the whole risk management process, if you know the basics, the more advanced part is integrating all this into your position management. And this is where the real mastery and the real magic happens, because with the right position management, you can increase your gains by tenfold in the right levels while having your risk still quite small. And all of that comes together at some point. In the beginning, it's just about executing, gaining knowledge, gaining experience, making mistakes, learning from those mistakes, getting to know yourself, getting to know your emotions. But then at some point, the real refining starts, position management, the beauty of leverage. It's not that you can build bigger positions, but I go deeper into this topic. It's all about risk management, more or less. Also, another question. You mentioned ETH and your spot position. Looking back now, it makes it easy, but I was live and saw sub 1400 price and I didn't take action to execute. I was waiting for 1300 to 1200. Actually, I took a massive position under 14K, 1400, but got stopped out because of a super tight stop loss, like $5. So the question is, a massive wick on a higher time frame, but on hourly or lower time frame doesn't look like this. How do you decide if PA is a fast wick or just going much lower? Do you look at something specific, such as making you aware that you are in a deep discount and trusting? Or are you looking at order flow, etc.? And one word, confluence. Again, on 3-day it looks like a wick, but on 50 minutes it was at the end of the world. I'm just trying to understand the difference between you and me when that happened. Okay, pretty simple. Separate your ideas. So looking at the 15-minute, while ETH is in deep discount, like in really deep discount at the range low, even sweeping the range low, looking at the 15-minute, of course it will look scary. It's designed to look scary if you look at low time frames. Don't fall for that trap. Don't fall for that trap. You're trading a monthly level, a 2-month level, whatever. Make sure you stay on those time frames for this idea. Of course, look at lower time frames. Try to add if you know what you're doing, even though it's very difficult. But you can do a lot of things, but don't mess up your higher time frame ideas by over-refining into such great opportunities. There is peak fear, there is deep discount, range lows, bullish order flow, everything comes together. You don't look at the 50-minute for this position. If you target range highs, you don't look at the 50-minute, and especially if you feel something, like if you cannot separate those ideas, stay away from it. Really, it doesn't help you at all. Make sure to, if you want to learn lower time frame trading, make sure it's not at the most optimal areas of the chart, because everything is designed on the most optimal areas. It's designed to look scary, or it's designed to make you euphoric so you don't sell. It's by design. And if you're not aware, if you don't have the experience, it will do exactly this to you. So stay away from it. Know that it's right to buy those deep discounts, but don't over refine on too low time frames for higher time frame ideas. It's really, I know what I'm talking about because I ruined good positions myself. I learned a nice skill for that because now I can refine my higher time frame entries on low time frame, but I usually have two different ideas. So if I trade this, for example, and even though this was stopped more or less, as said, on spot plays I play with soft stop, which means I wait for a close below this low. I don't touch the position. Doesn't matter. If we close below, I cut it. But this is what I do. I buy spot, I remove it from the exchanges, so I cannot touch it anymore. And if I want to sell it, I need to send it there, and I only do that after a close. And if I want to add here, let's imagine you said 1400. If I would like to add here, it's a different position. I don't add to the same position because one is spot, and I probably wouldn't target this as well. I would first of all target this, and if this is breaking, I could trail. And I would open a second position on a different account. If I build I don't like building per positions long term because of the funding fees and all that, and being exposed to the exchange for too long. So I usually play spot for these higher time frame ideas, and then I add for a lower time frame idea, mid time frame idea, or for the same idea, but with a closer target and a tighter stop loss. And this is how I can increase gains, TP on the small position while being exposed on the spot position for way higher targets. Just make sure I'm consistently profitable. I'm exposed anyway because I'm in this wide one. It's very unlikely that this is getting stopped. I mean, even though it was technically here, but we hadn't seen the close below. And so I'm exposed. My mental game is fine because I'm exposed anyway. I try to add on lower risk. As said, my perp account is way smaller than my spot account. I try to add on lower risk, very tight, which is of course a higher R, which of course pays me in the end maybe even more than the spot position if I do it right, or at least the same amount with less risk. Even though it's more or less the same risk because it's tighter and all that, but you know what I mean. Steno, I did mix the high time frame, mid time frame, low time frame lot. Your answer is crystal clear. Thank you. Yeah, I know how it is. Believe me. I mean, I learned this all myself on the hard way. Just take advice from me. You don't need to make the same mistakes for too long, because higher time frame is your easy money play. Your main focus should be on that. And if you have the mental capacities and if your mental game is on point for that, you can drop to lower time frames, but separate those ideas. They have nothing to do with each other. Oh no, you guys didn't hear me. How long was I gone? Okay. Strange. Might be. It's even stranger that it's for some people it was a problem, for others it wasn't. So I guess it might be on Discord. At least that's how I comfort myself now. Yeah, sorry guys. Just a little conclusion of what I said. I said a lot of things, but you all saw my screen, right? My screen is still fine. Please interrupt me immediately if you see something or don't see something anymore. Yep, it's good. Okay. Just to conclude the main idea, don't mix up your higher time frame ideas and your lower time frame ideas. Your higher time frame ideas are your most optimal, should be your most optimal easy money plays. Don't mix them up by dropping on lower time frames, on time frames you're not ready for, or don't forget that the deep discount of the range is always designed to trigger fear. So everything on the chart, everything in the news, everything in the whole world is designed to trigger fear, to keep you away from buying or even make you selling there. And everything on the range high in the premium is made to make you euphoric, to make you buy, or to make you not selling. This is very important. And if you're able to separate those ideas in your mind, you can try to add to higher time frame ideas in lower time frame, but this is very advanced. And most likely what will happen is that you're getting scared on lower time frame, fumble your higher time frame good position, and then you're sidelined for a whole leg up and you don't know what to do. So separate your higher time frame ideas from your lower time frame ideas and stay away from lower time frame if you don't feel ready, or if it's a most optimal key level, scale in around it. There is no perfection needed. It's just about getting exposure in this area of the chart. And while it looked very scary on the way down, now looking back, everything is very obvious, and it was just the perfect time to get allocated. And it doesn't matter if it's at 1800, 1900, 1700, 1500. Of course, the lower the better, and you can scale in, like ladder in your buys. But in the end, looking back, it doesn't really matter. At least you're exposed somewhere in this area. So conclusion, don't mix up your trade ideas. Have your higher time frame ideas separate from all other ideas. Portfolio management suggestions could be a very nice addition to the course. It added up very nicely with risk management, position management, and journal routines. For the long run, first 100 trades to 1,000 trades. Yeah. We are still working on the course, and we will probably update it. And so, yeah, this makes sense. The thing is with portfolio management, it's so unique to everybody. So, you know, like the whole portfolio size matters a lot. Then the whole living situation matters a lot, because if you're still working a job, if you already have houses, or you whatever, like getting paid a lot of money, getting paid not so much money, there's a lot of things you need to be aware of, especially also the level of experience, because I'm mostly allocated into assets because I do this for a living, not just crypto. As said, by now it's only 55% crypto, and I allocate more into TradFi, more into commodities and all that, because I just want to diversify my portfolio more. And in the beginning stages, my portfolio was so concentrated. I was having a lot of stocks as well, but still the biggest size I had was in Bitcoin. And this made a lot of sense for my portfolio size back then. But by now, I need to be aware, especially because I really don't want to allocate into Bitcoin here at 120K. I will be big into Bitcoin once the risk off cycle is over. But right now, I need to reallocate myself completely different. So this changes month by month, quarter by quarter. What I tell you now might not be true in a month from now, and what I tell you now is maybe not suitable for you at all. It also depends on in which country you live, how stable your currency is. Maybe you want to allocate a lot of your money in other currencies. If your currency is very weak or very volatile, there is so many things to it, and a lot of those things probably exceed the beginner's course a little bit. But yeah, like the portfolio allocation, just of how much you should allocate into which account, per account or whatever, makes sense, and we will probably add that. Yeah. So I use this little time of no questions for showing you the power of position management. I just think of a way which I can show this in the most effective way, because if I write while I talk, I will probably not be as concentrated. I try to explain it without showing you something. The power of leverage. Can I do that? The power of leverage. Maybe I have some picture or something. Let me check something. Let me go to the course, because with a picture, I think it's better understandable. Is it position management, right? Is it? I think here. So oh damn, I need to fix this, as it seems. Oh, this is really fucked up. Sorry for this guy, guys. It shouldn't look like this. Okay, anyway, your trading window will probably look like something like this. And what you want to do here, you want to adjust your leverage as high as you can. So your return of equity, which is this, should never exceed 50%. We explain all of that in this post. And here, this amount, the amount of money you can lose on your risk, is your risk, which should always be a dollar amount. And this has nothing to do with your margin. This amount here is the money you're able to lose. So on a 10K account, this would be 2%. On 50% return of equity, minus 50% maximum. Why? Because if you go higher, you risk getting liquidated. But you can choose the leverage as high as you can or as high as possible until you reach this 50% return of equity, minus 50% maximum, which then makes it possible to have less exposure to exchanges. And then leverage becomes a risk management tool for you. Because this means you're not exposed to the exchange as much. And this is very important, especially in crypto. I mean, if you trade TradFi, this is not so important because usually your TradFi broker is saved or is paying you on something like in most countries until $100,000 back if they go broke. So or the government or some security system or whatever. So usually this money is backed. On crypto exchanges, it's just gone. And crypto offers a lot of good opportunities, a lot of inefficiencies to trade because it's a smaller market. So in my opinion, I like trading crypto the most, but you really need to manage your risk. And with leverage, that's definitely possible. For this example, with the 10K account, you can now go up to 50% return of equity, which means for, is there a margin anyway? No, it's not. Cost here it is. You need $400 margin for this position. So if it's on a 10x leverage, this is a 4K position size. And with this 4K position size, your maximum loss with your stop loss is still just $200. And your margin is $400. And if you get liquidated, your $400 are gone. If you get stopped, your $200 are gone. So you want to make sure that your return of equity is maximum minus 50%, because that way you make sure to not get liquidated on a big cascade or a big flush. This is very important. And you can turn the leverage up to this point. So you only need $400 for a 4K position. And let's imagine your account is, like in this example, a 10K account, and you trade with $400 margin. You can open another position and another position for a $200 margin. And on lower time frames, if you play with 50x leverage and stuff like that, $200 margin is a lot. And all of that is risk management. Leverage is not that you can play bigger position sizes. It's not that you like trade amounts you're not able to trade otherwise. It's a tool to have less exposure to exchanges and to use your margin more wisely. And then there's also the way the opportunity to have also the opportunity to remove your margin in the end. I made a separate post about this. And then you can use this margin again. So let's imagine we took this trade. We had a $200 stop loss. The trade reacts here. It was actually an example on Bitcoin. So our trade reacts, we are in profit, we move our stop loss to break even, or at best case above in profit. We adjust the leverage higher. We can turn it up to 500x. That's why my P&L cards often look like 500x. I never open positions with 500x, so don't get me wrong, but I turn up the leverage as high as I can to remove as much margin as I can, and then I can use the same margin again and again and then again. And I can open 10 different positions. I can pay myself out with this money, and the positions run on no risk. Until yesterday, I got 3 positions on Maxi running, all in big profits. All the margin was completely removed, so I had no exposure to Maxi. The only thing was that it was at risk was my profit on this position, which is like a reasonable risk to have, because without risk there's no profit, but I minimize my risk as much as I can. And this is what you should do as a trader. The best traders are the best risk managers. Do you use the same fibs as Albert or different? I use the same fibs. I mean, there are the minus fibs for like extension price discovery targets. And then of course I like to call a fib a range measurement tool, because in the end a swing high to a swing low is nothing else but a range. So in the end my 0.5 is the middle of the range, and is my equilibrium, and then everything in between are just grades, or what's the name, like steps within this range. And everything, like in this case, is a bullish swing. We are right now at the range high, so I'm only looking for trades here, like these, from this area on, the most optimal trades begin until here, and of course the range low itself. But if we lose the range low, of course the range is broken and we need to consider more downside. And then you have, of course, you can define ranges within the ranges, and then it gets, of course, more complicated. But then this already becomes a little more optimal here, and you have confluence for the bigger range, and then I can make it really messy by adding another range, even though this is just this big wick. But you see, within this range, we delete this, within this range, this level is almost at the 0.5, but we had never, if we trade this level, if we're trading this level here, it's never as perfect as those lower levels below equilibrium on both ranges, on both swings. So this is not as optimal as the lower ones, and so we risk accordingly. We risk less than at the more optimal levels. Yeah, I definitely share this vision. Portfolio management is really important thing. I just need to think about something that is suitable for everyone, and just a general guidance and not so specific. And yeah, but I will figure something out and add it. How optimal would you rate this level on ETH? The green one, it's all right. It's something I want to trade, especially looking at all majors. I mean, we have this level on the Euro charts, we have this level on Terra Dominance, we have a level on ETH BTC. So there are so many confluences for this level probably, that I definitely rate it as optimal, even though it's not most optimal, but it's definitely enough confluence for me to put on at least 1%, maybe even adding, if I get confluence within the level, execution tactics, all that, maybe even add with a tighter trade another % or something. And this is also, again, power of risk management. I would probably play the first level, probably, yeah, let's do the structure. Would probably play the first level like that, with a limit order, 50% of the size, market ordering for this higher time frame trade idea here, targeting probably the monthly order block, but at least those highs. It's nothing fancy, but it's only a 3R. But with this, I can leave a limit order open, and I'm pretty confident that this is not being flushed in one big move. If it does, my risk is predefined. I have nothing to fear, but my 1%, and this is just the risk I'm willing to take. And if I'm at the charts, if I'm awake, and we come back down here, it's just one idea of many. Let's say we do something like this, and then I get my confirmation here, and I get a retest here, and there's some levels in here on lower time frame, mid time frame. I could think of adding to this position, or once I see structures changing internally, tightening the stop loss. This is also something I like doing, because at some point I just say, okay, we shouldn't lose this low anymore, because if we do lose this low, my trade idea is invalidated anyway. So I can tighten my stop loss. I don't need to move it to break even right now already. So I can tighten it, and then it's probably, if I'm at 1% here, it's only half, so it's only 0.5% here. So I can add another 0.5%, which maybe betters my average or worsens my average, but I'm still adding to this position because it seems to play out. Or what I also like doing is keeping this position like this and adding with another position, something like that on the retest here on the time frame. Structure is changing, targeting only this or this high, TPing definitely earlier, and trying to trail as much as I can, of course, but still this is my high frequency TP position while I try to milk this one as high as I can, same way like I explained it down here on the high time frame position. Yeah, which is very powerful if you know what you're doing with the position management, risk management stuff. And in the end, 1%, and if I add another 0.51%, but with such a tight stop loss, I can double my position size on only half of the risk, which is power of risk management, power of position management. Great trade idea and plan of execution. Yeah, and this is, to be honest, this is how I like to trade my higher time frame ideas, all my higher time frame ideas, because as said, I'm not a friend of taking lower time frame trades in a choppy range within something. I like to take my lower time frame trades within an alignment and in a higher time frame key level, because more likely than not, this higher time frame key level reacts. And if I know what I'm doing, and even if it does just this reaction here, and then it just blasts my level, because this is of course also always on the table. And I was already able to extract 3R if I do it right, while being on the white one, it's only at 1R. But if I see signs of rejection here, my risk is probably removed, and I move the stop loss to break even on this one. And I TP'd on this one. I did this recently on Doge, even with live execution, so there's proof for that. This is how I like to execute all my trades, and the smaller position is already making me profitable and making me more comfortable, should this not retrace, to keep on holding to this trade idea, because otherwise I'm probably a little bit like aggressive with TPing, and on such a wide stop loss, it's not the most profitable trade. And combining these two approaches, being always exposed with a wide stop loss, so I'm the same as I did here, I'm doing here, which makes me exposed. It's good for my mental game, it's good for being exposed, and a small one to make me profitable along the way, which is good for living off trading. And of course, being wrong in the higher time frame idea, because we could also reverse from here, and I missed out TPing it completely because I say, no, this was not the idea, and they round trip the swing trade completely. But the smaller one was already profitable, so it was a win anyway. But the idea is nice, but of course also this is on the table. Even though it's the best idea, it can always fail, because it's always probabilities. That's why I don't go in full size. Yeah, and always define ranges. Ranges are also nice. Play the probability game. That's it. Yeah, exactly. That's it. So let the statistics play. Play a statistical proof match. Let favor be on your side, and accept the probabilistic nature of the game. Because as you saw in the statistics, 6 consecutive losses, even on a 50% win rate, This is just mathematics, and it can happen. And this is not your fault in the end. Sometimes it's just like that. I mean, with position management, you can minimize those losses, or you can cut them early and all that. But in the beginning stages, we'll probably play it like stop loss or TP, and that's totally fine. Do that. It takes a lot of experience to drop to low timeframes and all that stuff. And if you accept and accept the probabilistic nature of the game, it gets also so much easier mentally, because you're not going to beat yourself up all the time, because sometimes it's just probabilities against you. The level is just not working. You couldn't do any better. Sometimes I also get stopped. If I do something stupid, which is not aligning with my statistical edge or my risk management and all that, even though this doesn't happen usually, I would beat myself up, because this is a mistake I did. So if I lose more than I should, or if I don't cut my loser when I should, and don't accept my stop loss and all that, or don't TP when I know I should, then it's on me. But if the level doesn't work, I mean, it's probabilities. It's like rolling a dice and then being disappointed because it's not the number you expected. Yeah, doesn't make sense. Do you trade with market structure? Yes, I do. I usually trail a little bit wider than most people, especially on spot. On perp, I'm a little more aggressive, but you have to consider that I'm living off trading, so I probably spend on a weekday 60 to 70% of my awake time with trading, or at least I'm always on top of everything, because I have my alarms and everything set up, and I'm always able to react if necessary. And if I know it's going to be an exciting or volatile day, I'm usually around on my computer anyway, or I'm not too far. So for me, I don't trail too aggressive. What I like is momentum trailing. I was talking about this in the updates as well, which is probably not the most beginner-friendly way of doing it, because those trend lines are very confusing at times. But to me, it just makes a lot of sense. For example, let's use this one, because there's all my drawings. So trade. You see, I was entering the spot position here, right? I was also entering along here, and I was TPing it all the way up. I TP'd on every little resistance on that one, and then I closed it completely once this trend angle was broken. So I just remove it. So, oh, not this one. So you guys can see it a little better. A little bit messy. So I was looking at this trend angle first, because usually the trend is getting steeper and steeper, and at some point it's not sustainable anymore. So at this first angle was broken here. I call it momentum trailing. I've not seen anyone talking about this, but obviously it's market structure trailing, more or less. We broke this angle here, this trend angle, which is just a sign that momentum was fading. So I closed this long, which I showed you from this area, closed it completely. I removed, of course, the line, because it gets so damn messy at some point. But we had this second angle here, and I was thinking we're going higher. So my base case was we're going higher, but even though I make predictions sometimes, I'm still taking it level by level. And if something, the trendline angles give me camel vibes. Yeah, indeed, I'm watching camel as well sometimes, and I like his trend lines, especially on higher time frame. I do not trade around them, I have to tell you that, because they're just meant for fuckery. Especially if you look at the low time frames, they create liquidity along the line, then they smash it, then they go higher again. But on mid to higher time frame, they can be a great indicator for momentum, in my opinion. And momentum was breaking down here. And I was saying, okay, good. I try to push this trade as far as I can. And I always consider the risk to reward of holding a trade for longer. So it's not just taking a new position, it's also the risk to reward. So I'm in the spot position, yeah, I didn't TP until this point. And then it breaks down here and I'm thinking, okay, so let's assess the risk to reward. I think it's going to go for the 1 month order block before going further down. And this breakdown could be a fake down. So I was assessing the probability and I said, okay, good. There was this euro level as well. This is my first soft invalidation, and the hard invalidation would be this. I ended up cutting the news the old spot trade. It's not a new trade, the old spot trade here. And the risk to reward of this idea, paying a little more back until the euro level gets broken, or worst case, this got broken, is still 3R. If my base case is that we are going only to this high, and should I maybe hold the spot bag a little higher because we could go 5% higher, the risk to reward of holding on to this spot idea or not TPing here is just very bad. And I always assess risk to reward even on TPing. Does it make sense to try to milk this position for a little longer, to push it higher? Because those swing trades don't come around every day. I try to ride them as long as I can. But in this case, it doesn't make sense. But because my idea was that we're going to a monthly order block here, yeah, didn't happen. We broke the trend line, first sign, we broke the euro level, all bullish levels, didn't give a reaction at all. And then I said, God damn it, I just cut it here. And yeah, as said, it's 7% lower than from the all-time high, but selling the Pico top is not very likely. So let's say I sold here, it's only about, what's now? About 5% probably. Oh, yeah, that's the trade window. 5 to 7% lower, which was totally fine. I TP'd 50% of my spot back because I wanted to TP at the range high anyway. And I just tried to push this trade a little longer, which obviously didn't happen. And then I changed my bias. I'm very flexible in my approach and everything's fine. So this is also trailing for me. For me, this is more like TP trailing, assessing the risk to reward every time new. I was also able to push the Doge trade 15% higher in May by assessing the angle here and waiting for the breakdown before selling, which also did me quite well. 50% is a lot for a spot position. And so, yeah, this approach is doing me well. And I have a fixed stop here, even though I have it as a soft stop because I'm always around, as mentioned. And also my coins, my Ethereum in this case are not on the exchange. So, and I don't put it on the exchange. So I just wait for this level to either fail or react. And if it reacts, good. If it doesn't react and we close below, I'm selling the rest of my ETH once we lose this level, which is my fixed stop. But I always also try to trail my TPs. I like to call it TP trailing, momentum trailing, whatever. And on per positions, I usually move my stop loss with the position, with the structure. I mean, I deleted everything. No, that's the wrong one. Where is it? I was taking this trade here, and then I TP'd on the way up, almost like 80%. I did another trade here. I TP'd 80%. It was stopped at slightly in profit. And I'm not a friend of aggressive, like trailing it like right below the structure. I usually like to go below those key levels. Have a fixed stop here, especially on the per positions. Have a fixed stop, no soft stop. But I did TP the rest of my bag this morning because I was saying, okay, good. First of all, it's on Maxi. I don't want to have enough more on Maxi. It's another 11% from my TP. And I can just use this money, which I took out, and probably reallocate it here because it's very likely going to go here. And if it's not, it's also okay. But yeah, I have my hard stop here, but in the end, I always trail in my head, soft stops, momentum stops. And ETH, the example was probably a little bit cleaner with the trend line. Those altcoins are often a little bit choppy. But yeah, this is how I trade. Yeah, glad that you like it. I like it as well. Sorry for being late again. Next time I won't. Have a great weekend as well, man. Yeah, man, they are. They are. And then especially Europe has winter and summertime, which throws me over every year. But it is what it is. Okay, guys, looking at my list, I think from my side, I talked about everything. I will give some more room for questions. So bring everything you have, because this is what it's for. But from my side, I've said everything. Ah, yeah, one more thing. I will send it again. Some of you guys already saw it already. There is this movie, which is actually, I sent it in the chat. There's this movie which is actually free, which is pretty nice, and it's a great movie about trading, and it really hammers one into mind how important risk management is and how important being honest with oneself is, and the emotional control part of things and all that. And it's even based on a true story. So it's really interesting. Watch it if you have time. I mean, it's weekend. If you want to watch a movie, why not this one? It fits perfect. It's the topic perfect. Start recording. What do you mean by that? I'm gonna upload it to YouTube because this is how I do it for the trader section as well, and this just serves me well because the files are way too big for Discord and all that, and on YouTube it doesn't really matter. I can just upload it, and I can share a link with you. It's still private or not listed, and then you can all watch it. Yeah, I appreciate all of you guys, and I'm happy that you like it. And as said, um, these classes are for your questions. Usually we pick a topic and we just talk about it, everything we know, and you guys ask questions after about this topic, about another one, doesn't really matter. It's just about your education and that you get the most out of it. And so if you want to do something else, or if you have improvement advice or whatever it is, this should suit you, should serve you. And so just let us know. Yeah, order flow is really a topic on its own. I can talk a little bit about it, especially the psychological side of things, because in the end, the market is just buying and selling. And if you want to, we can do this the next session. I will usually take Saturday. No, we haven't agreed on that. We will see. Maybe I do Thursday next time and whatever. But once a week it's my turn, and once a week it's Albert's turn. And we can talk about order flow next session. But I will probably not be able to go in the whole depth of everything, especially because considering that it gets very confusing at some point, and also in crypto there's so much to it because of all these different exchanges and that. But especially what the order book is and how it moves, how prices moved, how they manipulate price and all that. This is very important because you really need to understand this for understanding what's the market maker's next move, what they do, why they do what they do. If I start trading with a $100 account, should this small capital affect my percentage per trade? Because some pairs do not allow $1 trades. Is it better to get more capital up to $500? Yeah, I mean, the main idea, as said, behind risk management is really that you're able to lose 100 times in a row, which is not very likely, but you should be able to lose like at least 20 times in a row and not being wrecked. If this $100 account is not wrecking you anyway and your asset is not allowing, or the exchange is not allowing you to trade with $1 risk, and instead you go for $2 or $3 risk, I mean, it's still all right. It's just about you implementing the system and understanding why you do what you do. And also your statistics are a lot cleaner if you risk the same amount of money all the time. But how much you should take, it's really up to you. The problem is if you risk $10 at one trade, then you risk $5, then you risk $1, and you have no consistency in the amount, your statistics are a little bit fucked up. Because if the $10 trade doesn't go well, and you lose it, and you win 10 $1 trades, you're still at break even, and then you think, oh, what I'm doing here? I'm trading. I take 11 trades and I'm still break even. But overall, your statistics are not that bad. I mean, you won 10 trades in a row, so you know what I mean. So better to set a fixed amount, and if it's only possible to trade with $5, might be a $5 trade, but you should stick to high time frame anyway if you're not experienced, and then a $5 trade is totally fine in my opinion. Yeah, basics of order flow and how. All right, to the recording viewers, we are back. The screensaver went on again and the recording stopped, but we are back in play. Yeah, order flow basics. I will cover this next time. I will write it down. And especially the order book, because if you understand the order book, everything else will click. But it's a little tricky. In the beginning, but it's not witchcraft, of course. A small walkthrough how you analyze a chart from scratch with a focus on market structure and how you read it, highlighting key levels. Yeah, I can do that. I'm a little bit lazy, to be honest, with that. So let's imagine what you're talking about crypto, I guess, because I analyze like stock charts completely different. But let me know if you want to see crypto or something else. Crypto. Okay, let's like some high volume coin, which I haven't charted. Okay, first of all, I want one with more history. I usually start with the chart with most amount of history. It doesn't have much more history. And then I have a look at the whole structure. Like, is it respecting the lows? Is it accumulating or is it just selling off? If we look at this low cap shitcoins and it's just grinding lower, it's probably a dead project. And every bounce is just to attract a new wave of FOMO buyers. But this chart doesn't look so bad. I usually look at those lows, check out if the accumulation is like from a certain area, so it's respected, something like this. You can also, it's always an area, it's not about the perfect line, but it's this area of reaccumulation, and as long as this low holds, the structure doesn't look so bad. And worst case would be this low here, which is 50% away. So for a higher time frame allocation, when I say, but I don't do that, but just as an example, if I want to buy AVAX here and I want to buy it on higher time frame, usually there's not so much to do, but defining a stop loss, defining a target, and looking at if it makes sense, and then I scale into it. If I really believe in the project, like for example, if this would be Bitcoin, and this is the bear market low, and I would really believe into this project, I would probably be very happy to start scaling into this, and the lower I can buy, the better. But this is obviously not Bitcoin, so I wanna have a deeper look, and I wanna refine my entries. And as said, I'm pretty lazy nowadays. I used to skip through all of the time frames, but I have this fancy indicator right now, which makes it a lot easier, and saves me a lot of time, and usually works also incredibly well. And so I see all of the levels already, then I usually double check them, and then let's imagine I didn't have this indicator, then I usually start way up here. What I can see is already that we're doing not so much over the last few years. And then I skip through all of them. We have a big order block here. Another one. So there's definitely demand down here. Another one. Taken. Another one. So this is already a very great area of interest itself, without much refining. We have taken this block already, but it's still partial down there. Another block here. So this area is definitely interesting for buying AVAX. Then we come to the refinement, which is a partial block here. Something occurring up here. We have supply here. And remember, the supply is stronger, the stronger the reaction is from the supply. So whales sold very aggressive into this. Here as well, aggressive selling, but not as aggressive as here. So this is definitely stronger supply in my opinion. Sorry, 3-week, right? Do we have? No, we didn't. There we have this refined level, which we saw before. This one. So this area is definitely quite interesting. Also considering that if I draw this trend line like this, probably gonna hit it soon. Or at least it seems like. And then I can refine all those partial levels and everything. And I usually, my approach is to make it less colorful. The stronger the level, the brighter the color of the box. More stuff here. leave a partial here, but this is really not so interesting to me, considering it's an altcoin. And then you need to consider that I'm trading altcoins really only higher time frame, so I really don't care about all the mid time frame crap that's going on, and everything in between those little ranges. If I trade altcoins, I want to have those aggressive big swings, which I trade, and trade them at most optimal key levels. So to be honest, I'm really only interested in this one. Looking at this whole chart. And I mean, considering the supply here, but I also really don't like. So now I could go into search all the levels mode, or I just turn on my indicator because I'm lazy. See there, I oversaw something. Just this is really nothing in my playbook. Also the odd ones, partial here. Mark it out. But I would probably, there's nothing I would like to short here in AVAX, to be completely honest with you guys. If I'm interested in this little shitter, it would probably be just belonging there. This one. Longing here, then usually I measure the ranges, find some FIB confluence. Yes, everything within the supply. Same for the bigger range. Usually it aligns somehow. The supply is really, really strong. So how would I trade this? I'm not interested in this little crap here. If I'm interested in the sweep of those lows. Stop loss below here. The stop loss is quite wide. This is like my first TP area, depending on how structure will look once we reach this, but I will definitely TP here, and best case would be up there. And this is how I would very basically look at higher time frame. There is definitely a lot of things I've overlooked now, but this is the most interesting information for me. We have this FEG here. We weren't able to take it out here. A sweep of those lows, major confluence, and I'm probably interested in this level. And I wouldn't short anything here. There's just better opportunities out there for shorting, especially considering if we reach this level, it will be so aggressive and probably overshoots and wicks, and then I could probably enter something on lower time frame if you're in the supply. But any other than that, I just keep it like this, to be honest. And this is how I would treat this trade or this asset here. But yeah, I don't trade AVAX, so I'm not very interested in this anyway. But yeah, this is how I would look at AVAX. And a stock chart as well. Stock charts are way different. You need to consider that oftentimes stocks are reacting at supply and demand a lot more. You have those ugly gaps. And usually supply and demand react a lot more. So there's also no reason for over refinement. I just went into this long here, into several long. It's actually targeting this. My stop loss is here by now, and I refined this to the green levels, but it's a lot easier to just go for supply and demand rules, simple supply and demand rules. And you have sometimes these double hidden, which react like crazy. but those normal hiddens are oftentimes not as effective as simple supply and demand. But I can start one from scratch. Let's take this one. Stocks are like sometimes a lot more crazy than crypto, and I like to trade those the most because, in my opinion, the more inefficient a market is, the easier it gets to trade. The more efficient a market gets, the more institutions you're on board, the more algorithms you have, the more efficient it is, the harder it gets to extract money, or at least the harder it gets to figure out the rules of those. And I mean, this was probably not so nice for early adopters, but there's something very interesting happening here. And for this, you need to understand order flow a little bit, but not too much. In the end, it's just about volume. And you see those candles, how ugly they look. They look like the 15-second chart. This is because the volume was like basically nothing back here. And then we had those first pumps, and they all aligned with XRP pumps, which is kind of interesting. This is, by the way, a quantum computing firm. And then we had a big pump again. Funny enough that it again aligned with XRP a little bit. And we had the highest volume since existence. And we're talking about billions here sometimes, almost in 2 weeks. And it's picking up, the volume is picking up speed and price as well. We weren't able to break out here. I mean, I longed this in this demand here, or I'll drop to low time frame so you can see it better. There was this happening in March. We had this little pump, and on the way down, I bought here, and those things move really like crazy. And to be honest, they move more than my cryptos most of the time. So I really started to like trading those, and they react especially well on supply and demand rules. Pretty simple. And you see, to me, I don't need to over refine on those. I try to get in with a clear invalidation, and I try to get out around. I mean, this big gap here is almost like a fair value gap. It's a little more powerful, and you have this demand here. And so I started selling into the supply, and then I thought, okay, good. If this trend angle is holding, same as on ETH, I tried to keep on pushing this trade. It broke down. I TP'd another 40%, which made the TP 85%. Since then, we're down 25% again. So these things move really, really, really super aggressive, but they are more regulated. They're not as manipulated. Sometimes they are, but it's not as easy to manipulate them as cryptos. And as said, if my broker goes bust, I get refunded by the government or by the broker itself, or by insurance at least. And now it's coming back to demand, and I'm re-adding some back here. And you see, this is a completely different approach because the chart is like a complete mess and something else than you used to see in crypto. Maybe one that's not so messy, but also interesting. Gaps. We have those gaps. Gaps are like pre-reactive levels, usually, not always, on stocks. And on those blue chip stocks, it's oftentimes hard to figure out when to get in because it's just up only in a parabola forever, almost. And I mean, if there's nothing like this, it's pretty hard to get in. And even if there is something like this, you will probably think, oh, damn, where should I go long? This is demand, this demand, this demand. It's pretty hard sometimes, but psychological numbers matter. So Google lost $100 here, which is always attracting new sellers and scaring new buyers because we lost $100, even though it doesn't matter at all. Demand, obvious demand, but very effective, as you can see. So nothing hidden, nothing fancy, just a monthly order block. And I wasn't able to catch, the monthly order block because I was looking at Google later, but I was able to catch the refined level here, which is actually refined. But it's also still in the demand of this whole area. And you see it's also just this big block, but you see it's so messy. they're so messy. You have so many gaps and all that. So it's rather wise to stick at higher time frames, but refine if once you're late or something. Usually price comes back and tests those demand areas, especially on higher time frame, because whales need more than one touch to fill at those levels. And now we are back at supply here. So I TP'd yesterday. I think it was 40% or something. Turned out to be a good trade. And if you break out from here, that's great. Then I'm in Google, which is a blue chip stock, and it's always good to have such stocks in the investment portfolio. And if not, I've already made a profit. And I do the same thing as always. If this is breaking down, not giving me the momentum continuation I would like to see, which just already seems to happen. Let's see what on Monday happens. I probably TP a little more, looking to add back here potentially. Time will tell. It also depends on if the SPX is doing what I think it does. I mapped this arrow out back here. It went sideways since then. It went a little higher than I expected, but overall I'm still expecting the timing. So the timing window is a lot more interesting to me than everything else. And I'm not trading this actively, but of course, if this gets invalidated and we just break down here and we don't even react at this demand down here, there's no reason to add to Google. But if this continues higher and the SPX is just keep on ranging or even going higher and invalidate my arrow completely, it's definitely nice to have Google in the portfolio, because I would argue Google is a nice company to have. And they're also pretty advanced in AI stuff. Any special thoughts about Forex? Yeah, I don't trade Forex too much. It's just not my type. As I showed you here, I love those highly volatile, aggressive moving, trending moving assets, and usually that's not what Forex does. Even though the euro rallied 15% this year, and I was scalping this a little bit and was able to pull a 10-hour trade within this move. But usually Forex is more ranging, so you end up more often TP1ing and getting stopped at break even, all that. And I like to have those swing trades which pay me for weeks or months, and then which move really trending assets, aggressive moving assets, and with nice and hot narratives on good volume and all that. This is what I like trading. That's why I like crypto as well, to be honest. Those swings which crypto does at times is they're really special and they're really great. And there is no market where I made so much money on those swings like on crypto. But yeah, in between it, there's a whole heap of nothing for a long time, just chop and making annoying me. And within those times, if you got some assets moving like that, it's not so boring in between. This is going to the basics. I've been trying to understand why LQ is in the body of the candle versus the wicks. Liquidity, sorry. I didn't understand what LQ was. Are we referring to the body having market-maker institution liquidity versus retail liquidity? My understanding of wicks it's the reaction from market makers pushing the price to zones where a lot of retail traders place their orders. So wicks contain retail liquidity, not market makers. Yes. The thing is, why we look at bodies. So if you look at a higher time frame candle, like the daily one, and you have a daily body, you know that price was moving in those 24 hours. It was moving between the whole area. So let's look at the wick candle. This one is actually a good example. So price was opening here, price was closing there. In between, price went up and went down, but it was not supported either way. it just hunted liquidity. It hunted stops to the upside, it hunted stops to the downside. But in the end, we opened here and closed here. So the real liquidity market makers were not willing to push price up here and hold it, support it up here. Because once they do this, people will start selling on them. Maybe other whales, maybe retail. Of course, they hunt retail, but it's not like they push price up and everybody's just buying to support this. No, some people are selling. And somebody, if price closes up here, somebody needs to hold price there. Of course, for the close, you can also hold it up there for just a minute and then the daily close there, and then you can nuke it back down. But that's why we look at several time frames. And oh damn. And if I guess it was this one. And if I look at the 2-day opened here and closed here. So we had 2 days where there was crazy volatility to the upside and the downside, but nobody was willing to hold price here or suppress price down there. So the market makers' interest, the real volume of the candle was all happening here. So for this, you need to understand the order book. For this, you need to understand what's inside of these candles. And that's why we look at different time frames, because on a single time frame, as mentioned, they can push price up for the weekly close just for this 1 hour, and then a nuke could break down, and then it seems like, oh, we had a close above. That's why I like several closes above or below. That's why I like full bodies are above or below, because this means we need to have a candle that closes above, the next one opens above and closes above, which means somebody is supporting price above the previous swing high. You understand? Market makers' interest, exactly, and because they're willing to only support price in this area and hold price in this area. So this is the real price. Everything that the wick does is just hunting stops, creating liquidity, and all that. It will get a lot clearer when I show you the order book next time, and we look at the delta cluster of candles, if you like. Because then you see the delta or the cluster of the price and how much volume on each price level was traded. And if the most volume was traded around a certain level, which in this 2-day candle was here at 3.789, that's where the candle body will be, because somebody is holding price there. The real interest of the candle, the real volume was traded in this area. Of course, there might be some traders trapped here, and they created a whole lot of volume. I show you the delta cluster next time with the order book. And the point of control of this candle might be up there, but still somebody just wanted to create this liquidity and trap them by pushing price lower again and holding price there. He's absorbing everything that comes higher and everything that goes lower, because he wants price to have it exactly here and probably sell this. And then once he's ready, he nukes price lower. And market makers are automated, right? Yeah, most are probably trading with algorithms by now. A market maker depends on what you think a market maker is, but yeah, most of all market making is happening with algorithms, and those algorithms are programmed to trigger emotions and reactions of people. But I mean, there are certainly whales out there which trade manually, probably because they just have fun doing it. But I guess most is happening with algorithms by now, yeah. This topic is what I need to fill in the missing puzzle. Yes, it will leave you with more questions than answers, probably. But it's to me, it's a very important piece of the puzzle as well, yeah. You certainly don't need to understand this. You can also just trade those levels without understanding what's going on in these candles. But it's so much more efficient if you know the basics at least, and to know how the order book is structured and what moves price and what doesn't, and what's the interest of market makers and all that. Because then you can think steps ahead. Yeah, aggressive and passive orders, that's exactly it. You need to understand the difference. Who does what at what time? What does it mean? Which traders have which interests? It's also a small part in the basic course. But as said, I don't want to go too deep in all of that because it will leave many people with more questions than answers, and it's certainly not so important in the beginning stages, but I can understand why you want to understand it. And as said, order flow is still important, and we do it next session. Do you take into consideration the tokenomics of a coin? I do if I plan to hold the token for a longer term, which is usually not the case anyway. Yeah, more or less, I'm very interested in Bitcoin so not right now, but I'm definitely gonna buy a lot of Bitcoin at the bear market because I think Bitcoin is meant to stay, especially now with all the regulations and ETFs and all that. I think it's not going to leave anytime soon. And the tokenomics of Bitcoin are actually quite nice and good. And for all other coins, I think it's just for manipulation purposes. And so it's kind of interesting sometimes how they use those narratives to manipulate people to know what the next steps are. But overall, from a fundamental perspective, I couldn't care less because I only trade high volume ones, and I usually have them not more than 3 months for just one swing. And tokenomics usually don't matter for me as trader. And if the tokenomics are so bad that it should matter for a 3-month time, I don't want to trade the coin at all. So this is something I usually don't even touch. But for those smaller coins I have, I don't know the tokenomics, to be honest. But it's so small size, and I don't plan to hold them long term. So I don't see a reason for that. Okay, guys. I think we're 2 hours in. My brain is fried, to be honest. My laptop is as well, because streaming and recording is a little much for him. Probably need to figure something out for this. No other questions for me. That's great. If you have important questions, drop them now. 2 hours is a lot to digest. Yeah, for me as well, because if I just ramble around for so long, yeah, I'm cooked as well, believe me. And I hope you found something valuable in this class. I'm looking forward to the next one. I'm gonna upload the recording as soon as possible. Now it's actually it's 3 recordings. I need definitely turn off my screensaver. And other than that, I wish you a great weekend, guys. Thank you for being here. And till the next time. Bye-bye.